In a world already reeling from inflation, shifting alliances, and post pandemic recovery, one man's trade policy has once again sent shockwaves through the global economy. US President Donald Trump's sweeping tariffs imposed on some of the world's largest economies were billed as a bold move to level the playing field and protect American interests. But days later, the numbers are in and they tell a very different story. So, what do the latest figures reveal about the real cost and benefit of Trump's tariffs? Let's break it down. Donald Trump's sweeping tariffs, aimed at rebalancing trade and protecting American industry, have triggered both upheaval and uncertainty. In the first quarter of 2025, the US economy shrank by 0.3%, the first contraction in 3 years. Businesses had rushed to import goods before higher tariffs kicked in, leading to a temporary boom followed by a drop in activity. Despite the downturn, Trump dismissed concerns. He blamed former President Biden, saying this will take a while, has nothing to do with tariffs. Markets, however, responded with skepticism. The Dow Jones fell 1.15%, the S&P 500 dropped 1.5%, and the Nasdaq slid nearly 2%. Earnings forecasts were revised downward and business confidence was rattled. Yet, not all indicators were bleak. Consumer spending held firm, the PCE price index remained stable, and Treasury yields signaled cautious optimism, with the 10-year note at 4.164% and the 2-year at 3.613%. China has borne the brunt of Trump's trade war. Its factory activity dipped significantly, with the April Purchasing Managers Index falling to 49.0, the lowest since December 2023, and below the forecasted 49.8. Non manufacturing PMI also weakened, signaling broader economic strain. The early year export surge, up over 12% in March, came from front loading before US tariffs as high as 145% took effect in April. Beijing retaliated with tariffs of up to 125% on American imports, but the momentum didn't last. As shipments slowed, so did factory output. The International Monetary Fund, Goldman Sachs, and UBS have all revised China's 2025 growth forecast downward. Despite official reassurances, the data reveals that domestic demand is sluggish and export driven sectors are under real pressure. Europe's first quarter numbers offered a rare positive. The Eurozone posted 0.4% growth, driven by a pre tariff export rush to the US, but that brief momentum was quickly snuffed out. On April 2nd, Trump slapped a new 20% tariff on EU goods, adding to ongoing levies on steel, aluminum, and automobiles. The response was swift. Economic forecasts were downgraded, and the European Central Bank cut interest rates for the seventh time, with inflation easing to 2.2%. Germany, heavily reliant on US bound exports, has suffered most. After 2 years of contraction, its GDP growth projection for 2025 was cut to zero, despite a €5 billion stimulus package aimed at infrastructure. Not all economies are hurting. Taiwan's economy surged by 5.4% in Q1 2025, its fastest growth in over a year. The rush to export tech goods before US tariffs kicked in, along with strong demand for AI chips, boosted key players like TSMC, Apple, and Nvidia. TSMC alone reported a 60% year on year jump in profits. As a result, Taiwan's full year growth forecast was raised to 3.6%. Meanwhile, India continues to straddle both opportunity and risk. Deloitte projects GDP growth between 6.3% and 6.7% for FY25, thanks in part to a 1 lakh crore rupee stimulus aimed at boosting domestic demand. Still, global trade instability remains a threat. A proposed US India bilateral trade deal expected by fall could ease that pressure and open new export opportunities. Financial markets have closely mirrored the global economic turbulence. In Europe, early quarter stock gains vanished after US GDP data disappointed. The Stoxx 600 slipped 0.12%, and the FTSE Euro First 300 dropped 0.18%. In contrast, Asia remained upbeat. The MSCI Asia Pacific Index rose 0.78%, and Japan's Nikkei climbed to 36,045.38. Emerging markets also posted modest gains, benefiting from the relative insulation from direct tariff battles. Currency markets reflected these shifts. The dollar index climbed to 99.42, while the euro, yen, and pound weakened. Oil prices plunged. US crude fell to $59.30 per barrel, Brent to $63.22 per barrel, marking their steepest drop in over 3 years. Gold retreated too, with spot prices dipping below $3,303 per ounce. From stalling factories in China to a tech boom in Taiwan, Trump's tariff regime has reshaped the global economic landscape. Whether this is the beginning of a global trade realignment or a temporary disruption remains to be seen.